Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The market since mid-January has run along down the underside of the purple highlighted upper time, currently at 2067. The early November 2023 to mid-January 2024 bearish shift pitchfork for a large part of its time. In late February for a few days, and then again in late March until last week, there had been a strong drive higher over the upper time, but the move up failed. The first time was at the overhead congestion between 2390 to 2408, and the second, most recent time, by the combination of the congestion in the 2235 area, the declining green highlighted short medium moving average currently at 2204, and the influence of the declining mauve highlighted medium moving average currently 2232. Prices 2 weeks ago started pushing down through the familiar stratified congestion zones between 2140 to 2148, 21 even to 2107, 2069 to 2076, 2047 and 2003. This general zone between 21 even to 2010 also features as a congestion area back between January and February 2017. By Thursday 2 weeks ago, prices pushed down back within the purple highlighted bearish shift pitchfork and then down through the previously highlighted bright red April 2020 to date uptrend, currently at 21 even. And the next uptrend, the pink highlighted April 2021 to date uptrend, currently at 2010. All the way until just short of the bright green August 2022 to date uptrend, currently at 1879. Some way below where the market staged a small turnaround in the middle of last week, and today has moved up to the underside of the broken pink uptrend. Now, I'll likely reassign these two uptrends next week. So it looks like the bearish purple shift pitchfork might have started to reassert itself, but I give it a few more sessions to verify. In the meantime, we have the conditions set with only a week and a bit left to go for April to be a possible monthly key reversal. Thus, if we close on the 30th of March either over 2258 or under 2252, a somewhat surprisingly narrow range, then we're beyond. Anything in between would have a lesser outside month pattern. Right now, we are very much looking at a monthly key reversal down. There is one final pattern I would like to discuss, and that is the new late February 2020 to late February to date bear channel. That's this year that I've drawn this week, highlighted in dark blue, and that's currently at 1903 to 2214. It is nascent, but it deals with the price action outside and above the purple highlighted bearish shift pitchfork, and it deals with it rather well. I'll see how this idea develops. Iced Europe white sugar in London. The market from the middle to the end of January had been wading through stratified levels of support and turning into resistances above, such that prices had dropped down to below the interesting 625.30 to 602.70 congestion area, and even dipped down below the breached, but at the time unbroken support of the purple coloured uptrend, currently at 609.70, dating from October 2022. There was some further congestion below between 590 even to 592.80, which finally held up prices in early March before we saw a move back up 6 weeks ago. Then 4 weeks ago, we had a break higher with a daily key reversal up, followed by a 2-day descending hawk pattern, a pattern traditionally seen as bullish, and prices punched up and closed over the green highlighted short medium moving average, currently at 625.70, using as a proxy support for a further attempt higher during late March and very early April, filling in the mid-February changeover gap of 643.5 to 650 even. For a while, it looked like the strongly declining medium moving average, highlighted in mauve on my daily chart, was giving way, and we did see it being pierced as recently as 3 weeks ago, but there were never two consecutive closes over it, and the medium moving average acted as a strong cap, helped by the 50% Fibonacci line of the January to September 2023 move at 652.20, and we saw prices turn around and head lower. Below the green highlighted short medium moving average, Then along it for 2 weeks ago, and at the start of last week, when the market created a quite good looking and strong key reversal down last Monday prior to a quite large changeover. This new gap saw prices drop down below the recent stratified supports and into open territory that just had the February 2017 high nearby at 565 even, and then really nothing until the March 2017 high at 548.70. Well, the market realized what this looked like on a continuous daily chart such as mine, and has seemingly stabilized and started to turn and try to fill in that gap of 613.40 down to 580.30, though it still has a way to go before it really starts doing that. However, there's always a tendency for markets to fill in gaps, including changeover gaps such as this, though I would not suggest holding your breath for this one. It brings me to a point I raised last week, and I quote, "Over the last few weeks I have been voicing a question here that I have been posing to myself. It is this: is the action since early December last year, is it developing into a double bottom or some sort of wedge or triangle pattern?" Last week it was still too early to tell, but I am more confident now that the late December 2023 to date action is perhaps a possible descending triangle. I've outlined the triangle on my daily chart in bright red. That's currently at 593.30 to 658 even. I continued, "This is a pattern to watch just in case it morphs into something else." End of story. End of quote. Today I am more unsure about this pattern than I was last week, purely because I do not like the changeover gap causing the market to drop below and out of the pattern. It doesn't mean it will not work. It's just that, well, I'd rather it move down during the course of normal trading rather than this. However, now that we are here, it would seem appropriate to set out some potentials below for the possible and somewhat short-lived descending triangle pattern. Thus, for a primary target X for such a pattern break, it would be down in the 544.80 zone, whilst a harder secondary target X1 should be down in the 497.60 zone, which is off the bottom of my daily chart. I'm really unsure about this one, and I'll watch it with great caution. Sugar white premium spread. It must be close to, if not over, a year here that this chart finds many things all still going on at the same time. Okay, so I previously spoken some while ago now about two big picture items seen here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my weekly chart, with the lower time below currently at 134.5. Tested but not broken even last week. We also have down there many of the moving averages between 130.5 and 140 even. Above, we have the congestion between 162.75 to 164.75. That contains the rising neckline extension of the June 2021 to May 2022 reverse head and shoulders bottom, currently at 164.75. Plus the 2012 high at 164.75. There is also further congestion nearby between 163.75 and 175. There's a pretty clear area topside after this, over the congestion at 178.5, up to the dark blue middle time, currently at 208.75 of the same bullish Andrews pitchfork. Last week the market made a huge combined weekly key reversal down and bearish engulfing pattern. I expect a lot to do with the London sugar changeover, but it still effectively countered the previous week's bullish closing white Mariposa over the September 2023 high at 171.75. Now last week I allowed myself to dream a little, look upwards and consider what might be the topside targets for the big elephant in the room, the big February 2022 to August 2023 diamond pattern, highlighted in green on my daily chart. Thus, a primary target X, which isn't that easy to reach, will be in the 250s area, 250 even zone, with a secondary harder to reach target X1, a much harder to reach target up in the 291 even area. I added, and I quote, "I can see my finessing these at some point as they are currently both off the top of my weekly chart." Well, and that's the end of the quote. Well, this week we have enough of the dreaming, and we will stick to the cold, immediate reality and consider the dark blue lower time, along with the nearby moving averages, as key element in the market, and no more than that for now.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.